back to Ask Avidian. I'm Jake Borbidge, Chief Investment Officer with Avidian Wealth Solutions. Joining me again today is Robert Palmer, Head of our Financial Planning Department. Robert, today we've got a couple topics on the lineup. We've got we're going to dig deep into our investment process. Actually brought along our investment allocation process manual with me. It's about 115 pages long. In the beginning. This is how we manage investments. No, we're not going to go through it in that level of detail, but I do think it's important to note that at Avidian, we are a fully transparent investment shop. So just to kind of tee that up, I thought it would, before we get into the investments process, just talk a little bit about why it might make sense to have transparency in terms of what you're doing from an investment perspective. You have any thoughts on that?
Yeah, I think there's two experiences to consider. One is the advisor's experience, and one would be the client's experience when it comes to transparency. So when I was working in the big broker-dealer world, and I believe I mentioned this before on a prior podcast, we never really got too much insight into why the investment team was making the moves they were making. And without that understanding, conveying an explanation to the client became very frustrating, not just for the advisor, but for the client too, because they realized that it was ambiguous.
Because they just want you to blindly follow it, right, without justification. That's kind of hard to do.
That's about right. And look, clients would specifically ask me, why are we selling this? Why are we selling that? And the answer was always a generic response about where we were in the business cycle in some larger secular rotation without any specifics as to what was actually going on.
Were there waving of hands in this presentation?
Well, my hands were waving usually because I talk with my hands, but yeah. There was no good cohesive way to kind of explain why we were doing the things we were doing. And that's where I think transparency really comes into play. Yeah. In the last podcast, we talked about eating your own cooking and not letting it sit at the pass. I always felt like things were sitting at the pass, and I never knew what was up there.
2 podcasts ago now.
2 podcasts. Sorry,
yeah.
I forgot how successful we've been.
Episode 8.5, I think, is where we're at. Yeah. No, that you bring up a good point, and I think I've been getting to know our clients in my first kind of year plus time here. If I look at our clients, I think one of the things that we strive to do here at Avidian is we offer, I call it the Avidian hug, but really what we're doing, one way to think about it is, it's football season, right? So like I've been going to some high school football games, watching the marching band, watching the game. And so, I try to think about the different capabilities that we bring to the table at Avidian that we put around the client as, they could be different instruments in the marching band, different instruments in the symphony, the orchestra, right? Depending on what music analogy you want to use. And I think our clients tend to sit in one of two camps, right? They either want to have all those tools, all those instruments playing for them, and they want to be the director of the band, right? And so they need to understand all the sheet music, all the different stuff that's going into, all the different resources they have access to, or they want to be in the front row watching the band play on, right? So we have both types of clients, but I think in either situation, transparency is critically important, right? Especially if you're trying to direct, right? You can't direct what you don't understand.
Well, also just going off that analogy, talking about sitting in the front row, from the big broker-dealer world, no client could do that. Advisors couldn't do that. You were completely siloed from the investment team. There was no way to see how the symphony was conducting, and there was no way to get a front row seat to that, which, as you pointed out, is a stark difference here. We communicate all the time about what's going on in the portfolios and about new opportunities, and we're able to convey that a little clearer to the client, which I think is, as you point out, a good differentiator.
Yeah, and as part of like the Avidian hug, right, as one of the members of the band, if you don't have transparency, you don't understand what's going on, you can't do your job as well, right? If you're playing, the trombone, I used to play the bagpipe harmonicas, my specialty. If I didn't know the music coming down the line, right, and I just tried to watch the conductor and do what, his hands were waving at and telling me to do, like I couldn't do my job as well either. And so I think it's great just to have the transparency because it lets the other parts of the process, the other individuals that we work with within Avidian, right, know what's going on, and they can do their jobs better as well. And so I was trying to think through, okay, well, there are definitely some shops that are more closed and less transparent, and there's probably some, good reasons for that. There's some, less good reasons for that. And so I tried to think through like, okay, well, what are some good reasons why, you'd want to obfuscate the investment process, right? You'd want to create that black box. And, the first thing that comes to mind is hedge funds. And this is not a knock against hedge funds. I think there's very good reasons for why hedge funds do not provide full transparency in their investment process. One is that there's information leakage that they're trying to prevent. Two is there's complexity. If you were to disclose the inner workings of something that's highly statistical, highly programmatic, the audience probably wouldn't really fully understand that. So there's some logic to that, but definitely protecting your information, protecting your intellectual property. But also, with a hedge fund, a lot of times there's a shorter term investment horizon. And so if you reveal some of that information, somebody may act on it, right? And if that information has a very short life cycle, you want to keep that as close to the vest, because if somebody else acts on it, they may take your edge, which obviously we don't have that issue here at Avidian.
Well, I also think it's important to highlight the differentiations between what we do and what hedge funds do, because as you pointed out, hedge funds, they need to maintain their edge, right? They have a vested interest in making sure that what they're doing sort of stays covert so other people don't replicate their success.
Yeah.
Whereas that is an investment strategy. Our side of the coin is comprehensive wealth management, right? It covers basically what the goals are, and if the investment strategy is fitting that goal. The actual investment strategy, there could be aspects of it that are somewhat ambiguous, like if you deploy a hedge fund as part of the strategy to maybe offset some risk elsewhere, or to complement the strategy elsewhere. But from our side of the pond, we want to make sure there's as much transparency as possible. Whereas on the other side, it kind of makes sense to have a little bit more of a secretive nature.
Right. And so that's one of the good reasons for having a lack of transparency, right? But that doesn't cover all of them. There's obviously just comprehensive wealth management shops that are less transparent. One of the things that I think about is, okay, if I didn't want to offer transparency, what are some reasons I might not want to offer that transparency that weren't necessarily great for the client? And so the first thing that came to mind is just kind of a lack of substance, right? If I'm talking about investment process, and I know that my process is not fully vetted out, that if I look under the hood, there's really not a lot there, then I may want to claim, well, it's proprietary, because I just don't want to reveal that there's just not a fully baked process, right? So I just call it proprietary. So I pull that curtain, I cover it up with that curtain. I don't reveal it. And that's, another, that might be a flag, right? If you think, okay, well, this is something that, should be transparent. I should have the ability to understand everything that's going on, but that's not being offered. That might be a little bit of a flag, a reason why transparency may not, may be a good thing in that situation.
Definitely worry me.
Yeah. The other side of it too is, you may not want transparency if you do not want accountability. And so one of the things that we do, and we spend a lot of time on, is measuring performance. Any investment decision we make, we communicate it after, very quickly after the fact. We communicate what we did, why we did it, and then we look at the performance of what we did and why we did it, and make sure that those things connect, right? So we are big believers in accountability. We'll be very upfront with what we have done that has worked well and what we've done that's not worked well. We know for a fact that we are not going to win every bet, every risk that we put in the marketplace, and we're going to always be upfront with what we did and didn't win. And again, the reasons behind it, the drivers behind it. And we learn from that. We get better over time as well. But if you do not want accountability, then providing transparency makes it, or not providing transparency makes it easier to not be accountable, right? So if you're not providing transparency, that might be one thing you might want to have as a flag. Okay, well, I don't really know what's going on but under the hood. And if I don't really know what's going on, how can I judge the result later on when I see, what happens in my portfolio?
Reminds me of the plausible deniability loophole for politicians.
Yeah, and it is a politically charged world we're living in right now, right? So with all that being said, right, again, we want to make sure that our clients have full transparency into everything that we do. We also believe that we are long-term investors, and so there are going to be things that I think are proprietary, the secret sauce to what we do here at Avidian. But the fact that we're long-term investors means if I disclose the active positions that I've put into a portfolio, I'm not going to flip those the next day. I'm not going to flip those within the next week. Those positions are going to stay in portfolios for, typically a good long time. Even in our tactical portfolio, think about a couple months, right? And so I don't need to worry about somebody going out and the next day taking the opposite side of a trade, because being a long-term investor, you have that long horizon to let your trades kind of work out in practice.
Just to add to that, one of the things that I think is important to just kind of highlight is scale. I was kind of harping on the big broker dealers, but they have a huge scale that they need to work on, whereas smaller shops can get more intimate with the details. If they're going to disseminate information on a massive scale and they don't want people panicking over short-term variables and they want them focused on long-term averages, it makes sense to keep the conversation higher level.
You got to dumb it down.
You got to dumb it down.
Yeah.
Otherwise, people are going to be panicking in the short term, and that's not going to be good for their performance. In fact, it may even be beneficial to provide that higher level analysis as opposed to that detailed one, just so they stay invested and realize those long-term gains instead of realizing short-term losses and panicking in like an '08 situation or something like that.
And I think here at Avidian, we just generally assume that our clients are of above average intelligence, right? So we don't have to dumb it down for them. We're going to give them just the facts, right? The straight stuff.
That sounds right.
Yeah. So let's talk a little bit about the investment process, right? So we have slides, we have just different ways of kind of walking through this, but the first thing we talk about with our investment process is that everything that we do here starts with a client conversation. We want to understand, and we partner with our financial planning team. We partner with our advisors who should know the client well. And then we partner with our clients. We want to understand what are the specific goals, objectives, pain points, risk, concerns with clients' liquidity needs that help frame the problem. That allows us, so we as an investment team design a lot of, we'll call it off-the-shelf tools, starting points, things that we can mix together to really solve for any number of combinations of client needs, client challenges, client problems. But again, investment process always starts with a client conversation. A lot of times that client conversations ends in what you would call an investment policy statement, right?
Yep, that's correct. And usually, as you harped on earlier, the goal setting becomes very important.
Harped on it. I'm harping on that? Okay.
Harping on it,
Man.
yeah. It harkens
Strong
back
word.
to an earlier part of the conversation where I used harp again. What I would say is that, financial planning in particular, the stage one, if you will, focuses predominantly on behavioral psychology and goal setting. And when you have all these tools, it represents sort of raw opportunity for the investor. And those goal-setting agendas kind of provide a lens with how to focus those opportunities to achieve the outcomes that they're looking to do. And I think that's really important when you're going through the pillars like foundational planning, risk management, tax strategies, estate planning, and then making sure the investments, which can be very complicated, tie it all together, right? That's kind of like the bow and the string that ties everything together and makes it cohesive. Mm-hmm. And I think it's important to keep that in mind.
Okay. So that investment policy statement for the client, again, provides transparency, gives them the rules of the roads, but it also sets the parameters for Avidian to work within, right? Once that's defined, my team has a set of marching orders effectively, right? We have a set of marching orders or a set of goals, a set of directions to take to form a portfolio. And a lot of times those directions tell us how much equity, how much fixed income, what a return target might look like, whether we can access illiquid markets or we need to stay in daily liquid markets. So very, provides a lot of clarity into how we manage the process or how we manage the portfolio. But from our team's perspective, what we do next is we try to understand, okay, if I don't have any active view on the market, if I just came into the discussion and said, okay, I only want to access the equity markets in as neutral a way as possible. That might just mean I buy the S&P 500 or I buy the MSCI World. Same thing on fixed income. I might just buy an index, right? That's always our starting point, is to not introduce our own active thoughts, active thesis into a portfolio until we have a high conviction in that active thesis, right? So we start with that kind of no active risk view. Some people would call that a no tracking error view, but it just simply follows a neutral stance of executing on those client goals. That's where our research starts. What we try to understand next is, okay, what is the market telling us in terms of the expected returns, expected risks of asset classes, different styles of investing, different pieces of the equity markets, the fixed income markets, how they relate to historical patterns, historical return offerings. And so we're basically going to come up with a neutral view. Then we're going to come up with what the street is giving us in terms of their expectations. And then we're going to look at our own research. Our own research might be understanding how the street typically forecasts returns and identifying opportunities where those forecasts can, run in a particular direction. A lot of times it's looking at what the street is telling us in terms of return expectations and comparing that to history and saying, well, today's return expectations are inconsistent with 90% of the history. And what we're trying to do in this active decision-making process, you could kind of liken it to just trying to stack the odds in your favor. So we like to think about it as if returns in a particular asset class, if they're expected to do something that's in the 90th percentile in terms of historical observation, the odds that actually materializes are fairly low. If the return expectations on an asset class have decreased to the level that anything the street is saying that, well, those returns are going to be in the 10th percentile, a very low expectation, then the odds that you could do better are very high, right? So we are trying to look for asset classes that exhibit those dynamics where placing a risk or placing a bet in that asset class, the odds are stacked in your favor that bet is going to work out better than just owning the market.
For the listeners out there, go back about 3.5, 4 minutes and listen to everything Jake just said with regards to the process for how to identify an investment strategy and how to curate it over time. And if you're not doing that, your strategy and your process can probably be improved by partnering with an RIA like Avidian. Because I'll tell you, just hearing that, because I managed my own portfolio when I was younger, and when you're younger, you can take all the risk in the world because you got time to kind of offset it. But as you get older and as your financial picture becomes more complex, maybe because you become more successful, you need to go through a process like you just detailed to really have a good strategy in place and to be successful at the end of the day. And I think people take for granted that the S&P is up as much as it has been in the last few years, and they take for granted that certain stocks have exploded their net worth. And look, getting lucky is fantastic. And maybe you did your due diligence and maybe you picked the right stock and you did great. But if you don't know how to take those gains and reallocate them to de-risk and position yourself moving forward in this new economic regime that we're finding in the world today, then you're not really doing your job when it comes to managing your own portfolio.
Yeah, and I think maybe just to kind of take that a little bit further, having a process, right, really matters. It matters because it helps you stick to your guns when markets are extremely volatile. It matters because it creates discipline and accountability. And it also matters because you always have a rationale for what you did, and then you can kind of revisit after the fact, did that rationale pan out? Did it deliver the performance I expected? Or did something go wrong along the way? Now, because we do a lot of manager reviews, right? Part of what we do is we pick managers in some cases to represent asset classes. So we hear a lot of pitches, active pitches, passive pitches. One of the things I think is really important is understanding, does the manager that you're working with have a process? And I think there's some key things that you can look for when you're doing that due diligence. We're just kind of reviewing these processes, right? I'll call them buzzwords, things that, when I'm listening, those make my ears perk up because I think, okay, well, there was some semblance of a process, but here there was a break. And then something gets picked up later on, right? And it's almost like if you were watching maybe a car move down the assembly line, right? Like you see the frame get put together, you see some guys welding it, you see them, maybe put on the wheels, and then it goes behind a curtain, and then all of a sudden a finished car comes out, right? Well, what happened in that, in that blank gap, right? Did they actually build a car there, or did they just have another car that was waiting to show up, right? And so when I think about investment process, you can see that as well. And typically, like one of the buzzwords that I look for is fundamental adjustment. So a lot of times what I'll hear an investment process that starts out with, we look at the markets, we forecast returns, we have a portfolio construction process that is a very data-driven, kind of mindset. But then there's this gap that says, then we make fundamental adjustments, and here's your final portfolio. So a lot of times the word fundamental adjustment or that phrase is kind of code for just going with my gut or doing what I think makes the most sense right now, because the numbers and the process that I designed are not telling me what I already think and what I already believe. So I'm just going to make some fundamental adjustments. I'm doing air quotes here to change that into something that just kind of sounds better. And I will be upfront with you that there are a lot of really good fundamental investors out there. We work with them every day. And if you walk through their investment process, which is fundamental in nature, there is very rarely a fundamental adjustment to account for your investment process not delivering what you want it to deliver, right? Fundamental investors still have rigorous and structured and established investment processes. And so there's no fudge factor that you just inject at the end to build a portfolio the way you just kind of preconceived want it to look. So that's definitely a buzzword to watch out for.
Well, I'll be honest with you. I love this language because the next time I make a gut reaction, I'm just going to call it a fundamental adjustment, and people will think I'm smart.
Well, that's great. And the other thing I think, gut reaction, hearing the words "I feel" in an investment discussion,
Love that.
Are again buzzwords. Sometimes they'll just slip into a conversation, but if you start hearing the, we feel that this is going to happen, that's another way of saying, well, we don't have data to support it, but we're going to do something anyway. And so again, it's just stuff to watch out for. So if we get back to our process, right? So we kind of touched a little bit. I mean, we've got the manual here. We're not going to go through that. There's an optimization piece. That's mathematical, right? Optimization means we're going to look at the portfolio goals, the portfolio objectives, portfolio constraints. We're going to look at our views, and we're going to use a mathematical formula to build a portfolio that's going to hopefully achieve all those goals, sit within the objectives, and then articulate our views, which a lot of times are numerical in nature, into a final portfolio. That's just kind of the setup, right? Or that's how we put stuff into the portfolio. A lot of what you do on the investment process is watching and reevaluating over time. And so, sometimes you talk about investment process, it sounds like it's you build a portfolio and then it's just off to the races. But much of the investment work is done in the second year, third year, 15th year after you start working with a portfolio, and just continually revisiting, looking at performance, looking at the data, analyzing, did you win on this thing? Did you lose on this thing? How can you get better? How can you control risk? Risk is something that continues to adapt over time. And so you always have to be cognizant of allowing your risk modeling to, or your risk measurement to be adaptive to the market as well.
And this circles back really well to one of the things you said earlier, which is transparency and accountability. If you're really going to constantly be improving as an investment team, you need to take accountability and have transparency into those variables. Likewise, advisors need to have transparency to understand what's going on, to communicate that with the client.
Yeah.
And they need to hold themselves accountable to make sure that the financial plan is getting updated to account for fundamental adjustments. Because there's fundamental adjustments in life too, right?
Yep.
There's huge financial variables that can come up at any given time, and the plan has to adapt with that like a living document. Similarly, investments is constantly faced with an insurmountable amount of variables every single day. So the term fundamental adjustment, it actually can apply to a broad range of things that should be part of an ongoing process.
Yeah. So we'll kind of shift gears a little bit, because I think we can dig deeper, but I think the takeaway for just talking about investment processes is, if you want to dig deeper, we're going to schedule a conversation. We'll meet with you guys face to face, right? To go deep into the weeds. But I want to give you a deep into the weeds example, because sometimes people just appreciate that stuff. And on the investment team, this is actually what gets us pretty excited. So we have a deep into the weeds example today about something that I think people tend to just take for granted, which is cash management.
Hang on, let me get the Excedrin real quick. Hang on.
So we had an issue come up, which I think is an issue that affected probably thousands of advisors nationwide. A major custodian of ours, not to throw them under the bus, I'm not going to mention their name, but a major custodian of ours made a change to how they manage cash and how they manage what's called sweep, which is you put cash in an account and hopefully it gets automatically put into something that's high yielding, right? So there was a change that was made. It went out to all advisors, and I'm assuming that it was announced in an email at the very bottom. It was not intended to be something that was broadcast very with a lot of highlight or just to really kind of notify anybody. It was more just like, let's have this kind of be swept under the rug. Given that it's cash sweep, right? It's very easy to think about it like that.
No pun intended.
No
of course.
pun intended.
Yeah,
no,
right.
literal facts, right? And so But the end result of this change to process is that a client's cash, right, typically just what, sometimes it's residual, sometimes it's a decent sized portion of their portfolio, depending on if they have purchases they're going to make or liquidity needs. The end result is that cash, which would have typically been automatically swept into a high yielding money market fund, was just going to sit in a much lower yielding money market fund. And just to kind of put some numbers to it, the high yielding fund at the time was probably 4.75%. The lower yielding fund that it was going to be defaulted into was more like 2.5%, right? So that's half your income on that cash. If rates were at zero like they were a few years ago, that's all of your income is automatically just gone due to this change, right? So that got us fired up, especially in the trading department, got really fired up about that change. And our trader said, no, that's not happening to our clients. To adjust for that, these are the things that he had to do to make sure that our clients, whether they were automatically swept into this lower yield, got back into that higher yielding product without them having to lift a finger. He had to go on our custodian's website, build out a custom data download, right, a custom report, pull all of our clients' information down from that custodian, and then identify which clients had this activity happening where they were not automatically being swept into that higher yield vehicle, recalculate and re-export all of that data into our trading system, and enter trades for every account. And he was really granular. We went down to accounts with as little as $100. Any account that had more than $100 of cash, we said, we want to make sure that cash is working as hard as possible. Okay. This is something that took several days for us to put together, but it's something that we really probably didn't even tell our clients about. It just happens, right? Like that is just something that, is probably one of a dozen different examples of things that just happen here at Avidian. As clients, you'll never really hear about it unless we make a point to kind of getting in front of you and telling you about it like we are now. But those sorts of things are things where like we kind of feel that's where we're adding the most value, is situations that otherwise could have resulted in a very suboptimal investment outcome for the client. We're just going to go and take care of that. We're going to fix it for them. If it's the hard yards for us, if it takes us more time, if we got to stay late to do it, we're going to do that because we want to make sure the clients are getting the right outcome here.
So just to summarize that, and correct me if I'm wrong, basically, in layman's terms, a major custodian, typically when you put in new cash, it would go into a nice high-yielding money market usually. However, there was a shift where now it was actually going into a much lower-yielding position. And so that just increases the tax drag, and it sits there earning a much lower yield than otherwise could have. And our traders were able to organize a system to ensure that moving forward, that new cash that enters the account is always securing that higher yield.
Yeah.
Is that fair to say?
Yeah, we're fighting back against the system.
Fighting back against the system.
Yeah.
But that's one of those things where if you're not acquainted with that custodian and you're not getting those news updates, your money could be sitting in that low yield and you could be missing out on 2-3% potentially. That's a huge thing to consider when you have a cash position.
Yeah, and I think if you're an advisor listening to this too, this is something that, if you have a trading department in your shop, give them a call, make sure they're doing this.
Yes.
If you don't have a trading department in your shop, I don't know what to do. It's kind of a tough situation to deal with. It's going to take a lot of work, but you should fix it for your clients too.
Get the pickaxe, bust open that black box, and see if you can talk to somebody.
Yeah, I mean, ChatGPT is good at coding. Maybe you can get the ChatGPT to help you out code something up.